Good day, everyone, and welcome to the Premium Video Newsletter for Monday, August 19th, 2013. I hope you had a great weekend. I try to spend as much time with my family on the weekends, but the markets always seem to keep me busy. Anyhow, let's get started with the fundamentals and work our way into the technicals from there. Unemployment rates rose in more than half of the U.S. states in July, and fewer states added jobs, echoing national data that showed the job market may have lost some momentum. Nationwide, hiring has been steady this year but slowed in July. Employers added 162,000 jobs, that's fewer than expected. The unemployment rate fell to 7.8%, a 4.5-year low from 7.6%. Intel led the Dow higher after the stock was upgraded by the investment bank Piper Jaffray, which raised its rating on the chipmaker, predicting strong sales for Intel chips for tablet computers and mobile devices. Actually, what's occurring today is interesting and worth talking about. If you recall, last few sessions I've been making a case for techs being stronger than the broad market. Today, Intel's getting upgraded, and the Nasdaq is substantially stronger than the broad market. It's weak and was pulled down by the broad market, but it's still much stronger than the broad market today. This is what I mean about the influence of semiconductors and how strong it could be on the remainder of the tech sector. I'm glad that the sector had positive news because it really demonstrated the strength and power of the semiconductor sector on the remainder of the tech stocks. And while the tech sector is not screaming to the upside nor making much higher highs, it is maintaining strength in light of the broad market. And the news today prevented the Nasdaq from breaking the low made during the last few sessions on the broad market. With that said, Intel is in a fairly strong downtrend right now, and I doubt very seriously this news will make the stock rally or move against the trend for more than 2 weeks, if that. Remember, markets tend to resolve in the direction of the trend, so keep an eye on Intel because it's one of the most influential tech stocks and does have very strong influence on semiconductors as well as the broad market. Speaking of the broad market, we took out the low today and could not maintain the support that the tech sector saw from Intel earlier today. It looks like we are definitely heading lower, and now we broke the 50-day moving average. This is when markets begin going on the radar list for hedge funds and large mutual funds that can sell hundreds of thousands of shares within seconds. So we have to be careful and mindful of that. The next support area on the downside is 1640, and the way things are looking, we are heading straight down there. Also keep something important in mind. If the broad market gets weak enough, it'll push the Nasdaq market lower, even if the semiconductors are exhibiting strength. There's just too many broad stocks in the Nasdaq market to counteract the broad market completely. But for now, the techs are showing substantial strength in light of the broad market. Taking a look at a few broad market subsectors, the retail sector is not helping this market retain any upside strength and is putting serious weight to the downside right now. The next downside support level is 78, and unless we get some positive news, and I doubt that will even happen before Wednesday, I think we will see the subsector at the 78 level soon. Remember, these are ETFs that are totally tradable. And if you don't see a market that I go through and want to see an ETF that mimics it, just send me a quick email and I'll send you a few right away. The last sector we want to look at is the financial sector. This sector and the retail are the big movers to the downside, and the financials look like they are the weakest subsector today. The next support area here is 1950, and it looks like the weakness continues. We will be trading there within the next few days as well. Much of the drop in the financials was triggered by the bond market and fear of rates going higher. The yield on the benchmark 10-year Treasury rose to 2.86% from 2.83% Friday. A week ago, it was at 2.62%. The quick rise in bond yields has worried some investors because it leads to higher interest rates and borrowing costs for all type of loans, including home mortgages and corporate loans. Some investors expect the 10-year note could rise above the psychologically important 3% mark as early as month's end. While I don't know if this will happen or not, I will say that long-term interest rates are going up. So only take trades in the direction of the trend, which is down. We took profits today on our short position at 114.5, which was close to the low of the day. The next step is to see if we bounce back to the top of the channel or if we break lower. Let's see how much range we have to the upside. If very little tomorrow, then there's a strong chance we can go lower, middle, or end of this week. Looking at the yen, it looks like we're hitting the low support on the uptrend lower channel. Here's where the interesting part begins. Do we break the channel at this point? If we do, we're going to the 100 level. And if we maintain the channel, we will most likely take out the high near the 104 level. I don't think this market is ready to go higher. And the reason why I don't see it is because we have very little momentum to the upside. Most of the trading has been very low volume and almost random. I want to see some commitment from traders, and I don't see it yet. In markets, weakness is implied unless strength is expressed. Remember that saying, it'll serve you well in the future. So unless I see some strength in the next few days, I will more likely be tempted to believe that we will hover near these levels for a week or so. Let's reevaluate this market in the next few days and see if we have a better reading then. The US dollar gained a bit of strength Friday as more news that the Feds will be cutting the stimuli program circulated throughout the industry. The US dollar will begin gaining strength once the stimuli program is done with, because there will be a tighter economic policy in the States. Most countries' currency is weak during uncertainty and aid from government, but Friday the dollar saw hope that the Feds will do away with the program sooner than later. But remember, markets tend to resolve in the direction of the trend, and only a day after we saw strength in the dollar, we started seeing weakness once again. Continue staying short this market and or fade the rallies. This is what I'm doing, and it's been working very well so far. We're almost at our target level of 80.50, so maintain your short position till that time. The plan is simple. Short the dollar till the Fed stimuli program ends, and then go long the dollar. Here's the big plan ahead. When the Feds end the stimuli program, the US dollar is going to rally, and gold is going to begin dropping. So what I'm looking for is to get the best price on the dollar before the rally begins, and sell gold at the highest price possible. And don't forget, when the Feds end the stimuli program, interest rate yields are going to go up through the roof, so bond prices will be going down. So far, my plan is working. The only part left is up to the Feds. Few setups for you tomorrow, including a 4x4 on LinkedIn, ticker symbol LKND. Make sure to go long 50 cents above today's high and place a sell stop $1 below today's low. It's a very high price stock, so we have to use higher stop levels, including our entry and exit level. The other trade is a short tail gap, and the ticker symbol is UNG. Place a sell stop 10 cents below today's low, and if filled, place a buy stop 15 cents above today's high. Cancel both orders if there's no fill by lunchtime, New York time. That's it for today's tutorial. Remember what I said a few minutes earlier about bonds, gold, and interest rates. It's all happening, and I'm glad you are joining me to experience it for yourself. Have a great night, everyone.